Hi, everybody. Welcome to On the Money. I'm Maria Bartiromo. The chairman speaks, the markets quake from Wall Street to Asia. What Ben Bernanke said that sent fear across the world, what he meant, and why it really does matter. Corporate America under the gun and two high-profile CEOs under the microscope by Congress and company shareholders. Who won, who lost, and what it means. And my conversation with some newly minted MBAs, their prospects, their ideas, and their dreams.
In 10 years, where does everybody see themselves?
On the Money begins right now.
This is America's #1 financial news program, On the Money. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on the money. Mixed messages from the Federal Reserve this week. It left the markets dazed and confused. Federal Reserve Chairman Ben Bernanke testified before Congress and said that the Fed could slow down its pace of $85 billion in monthly bond purchases if the economy picks up.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
Then, separately, the Federal Reserve's Open Market Committee released its statement from the previous month's meeting and said that the tapering of purchases could come as early as June. That spooked the markets, which sold off big time on Wednesday, then recovered on Thursday in spite of a huge decline overseas in Japan. The markets were mixed on Friday. Retailers were in the earnings spotlight this week. Staples and Lowe's fell short of analysts' expectations, while Home Depot, builder Toll Brothers, and technology giant HP beat expectations. Hewlett-Packard shares, by the way, up 12% on that news. Yahoo opened up its wallet and spent some cash. The internet giant buying blogging site Tumblr for $1.1 billion. Tumblr's founder and CEO, David Karp, who is 26 years old and a high school dropout, walked away with about $200 million. He said the deal made long-term sense and it would keep Tumblr independent.
The structure of the organization, the company that we're building, for me, it's been about the mission. And this is an incredible opportunity to serve that mission for a long time.
Ben Bernanke and the Federal Reserve's Open Market Committee had a lot to say this week, and to put it mildly, it caught the market's attention. What was the message and what was the meaning? Joining me right now, Bob McTeer, former president of the Dallas Federal Reserve, and Keith Banks, president of U.S. Trust. Gentlemen, good to have you on the program.
Great.
Thanks so much for joining us. Bob, let me kick this off with you. Everybody was watching and listening to Ben Bernanke's testimony before Congress this week, and separately, the Federal Reserve minutes that were released this week. Now, the minutes, or, the notes from the last meeting, seem to say that the tapering of the Fed's bond buying program could begin as early as June. But then Bernanke said it all depends on the data. What do you think?
I doubt that it'll start in June. Remember that the minutes reflect a debate that's going on, and it's easy for the participants in that debate to forget that there's going to be a counting come 3 weeks later. Also, the word participants includes, I assume, non-voters as well as voters. I think when it comes right down to it, Mr. Bernanke will have all the governors with him and most of the presidents.
So when would you expect the Federal Reserve to slow up on the stimulus?
Oh, probably around September.
September of this year.
Yeah, I don't think it'll be dramatic. I think they might say, well, let's go with $50 billion of long-term treasuries and drop off the mortgage-backed securities.
So, Keith, that's obviously what the market's waiting for, and so skittish. The one mention or suggestion that the Fed is going to stop the stimulus turns this market into, a massive sell-off. What do you think is happening? What should investors be thinking about here?
A couple things, Maria. Number one, I think people are misunderstanding what the process will look like and actually be when the Fed does begin the tapering and ultimately tightening. People think it's an on-off switch. It's a dimmer switch. It'll probably be 4 or 5 steps before you actually see rates rising. So number one, it'll be much more protracted versus, again, on-off. That's number one. Number two, people are waiting for a big pullback in the equity markets to move into move cash or move fixed income. They're not getting them. It's been shallow, it's been short, so it's been a trickle. And as a result, people are kind of caught in the middle and not doing what we think they should be doing, which is increasing their weighting in equities.
So what are you seeing in terms of your clients right now? Are they cautious? Are they putting money in cash? Are they keeping money in fixed income? How would you break it down?
We've got our clients have about 10% of their assets in cash currently, so that's down. They still have a fairly big exposure to fixed income, and we're continuing to try to get them to shift, especially their fixed income holdings, into equities, because we believe that we are still in the early to mid phases of a secular bull market that we think by 2015, you could be somewhere in the 15, and the 1950 range for the S&P 500, so well above where we are even today.
I mean, just last week, I spoke with the CEO of Credit Suisse, and he was telling me about his private bank. And he told me, this is Brady Dugan, CEO of Credit Suisse, he said 30% of his clients right now are still in cash. Listen to this. I'd like to get your reaction.
Yes, they still have a significant percentage in cash. So we've seen some of that move into equities. We've seen them maintaining their allocations to fixed income, actually. So I think that there is still room for money to flow into the equity markets, which I think, gives you the view that perhaps the market certainly has further run.
Keith, your company just released a survey that showed similar results for wealthy clients. That they are actually also cautious. So what does that tell you in terms of the potential for the market? It's
interesting. On one hand, this survey, and these were non-U.S. trust clients, were saying they're optimistic about today and the future, and they're also said that they were trying. Their focus was now more on growth of assets, not preservation. But on the other hand, the disconnect was, to the point you're making, 56% said they had a lot of cash still in the sidelines with no immediate intention to move it. So I think people are still very slow to translate feeling better about things, the economy, employment, and others, and translating it the way they ultimately need to with respect to the asset allocation they're actually undertaking.
Bob, what can you tell us about the economy right now? I mean, housing seems strong. The autos are picking up. Where are we in terms of the economic recovery in your view?
I think it's picking up some strength, but it sure is halting. You get a plus 1/10 increase in retail sales, and people think that's great because it didn't go down. And then you lose a half percentage point on industrial production, and nobody seems bothered. I think the economy is improving, but I don't think it's improving enough the positive mood out there. I think is based more on what's been happening to the stock market than what's been happening to the economy.
Does that bother you, Keith? The fact that this rally is largely based on the Federal Reserve's easy money policies and not necessarily all on fundamentals? Or do you think that's wrong?
I don't think it's totally wrong. I think there's no question that liquidity was a big catalyst for a big part of the move in the markets. But let's not forget, earnings this year we think will be $108 a share. That's another record for the S&P, for a record year of earnings. We think next year there'll be 112, 114. So there's still a fundamental underpinning in addition to the liquidity, and that's part of what we think people are forgetting. So even though Bob's right, I mean, the economy has been tepid, 2% growth and 7.5% unemployment doesn't get you real excited. But given how much companies have streamlined, it's still translating into record profits and record levels of cash. People also forget, Maria, companies have $1.5 trillion of cash on their balance sheets, which we think they're going to start to or continue to increase dividends, continue to buy back stock. We think M&A activity will pick up significantly, and that will ultimately allow them to hire more people and put more money into capital spending, all of which is good, all of which is positive for the equity market.
That's great conversation. Gentlemen, thank you very much. We so appreciate it. Bob McTeer, Keith Banks joining us today. Up next on The Money, corporate America in the hot seat. What this week's focus on the CEOs of the biggest bank and the most valuable technology companies say about our feelings on business. Carly Fiorina, the first woman to run a Fortune 20 company, will join me next. And later, looking at the investment of graduate school in today's economy. The class of 2013 will weigh in.
I look at the world with completely different eyes than what I did going into it.
As we take a break, take a look at how the stock market ended the week. Back in a moment.
what I really wanted to ask is why the hell I have to keep updating the apps on my iPhone all the time, and why you don't fix that. I thank you, Mr. Chairman.
Sir, we're trying to make them better all the time.
That was Apple CEO Tim Cook in front of a Senate subcommittee this week addressing an investigation that the company shifted billions of dollars away from the U.S. by taking advantage of low tax rates overseas. So what does this public inquiry say about the feelings toward business in this country? Is there a target on corporate America? Joining me now is Carly Fiorina. She was CEO of Hewlett-Packard from 1999 to 2005. And Carly, it's always wonderful to have you on the program. Welcome.
Great. Thank you so much for having me, Maria. Great to be with you.
The CEOs of the world's most valuable technology company answering the questions of senators. What was your take on those hearings?
Well, unfortunately, I think it is misplaced political theater. Look, I don't blindly defend business. Business sometimes does the wrong thing. There's no question, for example, that Wall Street helped create the financial crisis along with Fannie Mae and Freddie Mac. And I've been public with you, among others, Maria, in saying that when boards do the wrong thing, they should be held accountable. But in this case, everybody agrees that our tax code is uncompetitive in its rate, it's counterproductive in its complexity. There's bipartisan agreement on that, and yet nobody in Washington is working on reforming the tax code. Instead, they're engaging in political theater. They're berating a CEO of one of the world's most important and most valuable companies who has been doing what a CEO is supposed to do, which is take his business to countries where people are making the strategic choice to lower their tax rate, which we should be doing, to attract their business.
When you were CEO of HP, you also built up in Ireland as well as in other countries to take advantage of various incentives. Do you see an ethics issue here to balance with the competitive landscape?
No, I don't see an ethics issue. I see a pragmatic issue. So it's interesting. Apple just recently announced as well that they're building a new manufacturing plant in Texas, not in California, for exactly the same reason that Hewlett-Packard and other technology companies went to Ireland. In other words, the tax code is better. Ireland made a very strategic decision in the 90s to lower their tax rate and to invest in their education system. And as a result, they attracted a lot of technology companies. Apple is competing in a global economy. They are trying to attract consumers from all over the world. And let's not forget that they are competing against Chinese companies, against Korean companies who have the support of their national governments. In this case, I think Congress, Republicans and Democrats, need to do what the Simpson-Bowles Commission recommended. Reform the tax code, lower the rates, they're now the highest in the world, simplify the tax code dramatically. That will raise corporate tax revenue, but it will also make us competitive and bring cash and business back home.
Carly, it makes so much sense. Why aren't we doing that?
What a great question. I think we're not doing it because it's hard work and because politicians keep finding reasons why it can't be done. Although, interestingly, politicians found the time to put taxes on the internet. Oh no, that can't be tax-free. It's hard work. It will take consistent attention over multiple political cycles, something that's very difficult for politicians to do. So a little bit of political theater is easier. Let's haul up a CEO, let's accuse him of various things, and people will think we're doing something. But in fact, we're not making much progress on this one, and that's a shame.
Absolutely. How does this play out for Apple as the technology sector continues to dominate culturally, commercially? I mean, there's a real breakdown between society and business, isn't there?
Well, sadly, yes. And this is, first of all, technology is one of those industries that's going to continue to define the 21st century. And we as Americans should be delighted that we have the leading company in the technology space. But we can't take leadership for granted. This is a hyper-competitive industry. It is a globally competitive marketplace. And so I would have so much preferred to see these senators asking Tim Cook, what do you think we can do to make sure that we continue to lead in this important industry? What are the changes that we should be making in the tax code, not one time, but on a systemic basis, so that you will bring some of that cash back home?
Now, Jamie Dimon also in the news, the CEO of the country's largest bank. He faced a shareholder vote on keeping both his chief executive and chairman roles. You served as CEO and chairman as well of HP for 6 years. What does this story say to you about the perception of corporate governance? Do you believe there is still a trust gap?
Well, I think there is still a trust gap, clearly, and in some cases that trust gap is warranted. But it is also true that there is no silver bullet. There isn't one size that fits all. In the case of JP Morgan Chase, it's pretty clear shareholders have decided that it makes all the sense in the world for Jamie Dimon to retain both roles. They decided that it would be overly disruptive. They also decided, by the way, that a couple board members needed to go. So there clearly are not completely sanguine about the governance of that very important bank, but they are extremely confident in the role that Jamie Dimon personally is playing.
You're absolutely right. Carly, good to have you on the program. Thanks so much.
Great to be with you, Maria.
Good to see you. We'll see you soon. Carly Fiorina joining us. Up next on The Money, what tomorrow's business leaders are thinking as they approach graduation day. I'll talk to freshly minted MBAs about where they're finding opportunity today. And you can find us on Facebook/Maria Bartiromo. Stay with us.
When you think of your life, I tend to think 5, 10, 20 years, 50 years, and I will remember what I did this 2 years.
From the class of 2013, we brought together 5 Masters of Business Administration candidates from 4 different universities for discussion at the NYU Stern School of Business. Their degree can cost between $100,000 and $200,000, and all of them, twin brothers Daniel and Andres, proud Texan Clayton, and entrepreneurs Jennifer and Hillary, took a break from their careers to attend school full-time. The post-graduation unemployment rate for MBAs is 4%.
Is there more confidence on the part of students today as they look toward graduation about the economic landscape?
There's less nervousness, but people are more so focusing on what they want, what they feel like will fulfill them as they step back out into the marketplace. I actually came to business school from the magazine publishing industry to pursue entrepreneurship. And I didn't know exactly what it would look like, but I knew I wanted to start a business in the digital space.
Why even go to school first? Why don't you just start a business? Why did you go back?
That is the exact question that I received from my bosses. But I knew that I needed to be in an environment where I could elevate my level of thinking, and it definitely paid off.
Being an engineer, I had a limited career path going forward, and I had higher career goals and aspirations. And I knew if I wanted to get there, I'd actually have to take risk, and giving up a job I loved with a great paycheck, to go back to school for 2 years, pay tuition, and not know what's on the other side of the door, and just hope I have a job coming out.
Now, Hillary, your first day on the job at Lehman Brothers was in September 2008.
Yes.
Wow.
Most of us are all familiar with what happened, and it was shocking and it was humbling, and it really kind of made you reevaluate how quickly small decisions can make a tremendous effect across the economy.
Then ultimately you decide to go back, get your MBA, and then start your own business. So was there something that happened during the collapse that forced your decision making?
I like the idea of being involved in executing and building things from the ground up. Lumi juice is our first consumer product, and it's a raw, cold-pressed juice.
So the women in the group here are the entrepreneurs. Daniel, you are going to work for Bank of America. When I speak to students, there's a real debate about Wall Street, about whether or not it's still the place that everybody wants to go.
It's a wonderful industry, and it is in transition. You want to be at the forefront of that. And from the client perspective, well, you get to work with very smart people in very challenging situations, and the deals you work with usually transform industries.
And you both, Daniel and Andres, you were raised in and educated in Latin America.
Yeah.
Colombia.
What have you found here versus what your education was back there?
I think that the biggest difference would have to be the sort of goals that people aspire to in the States. Notice that people here tend to think really, really big.
Can you characterize the last couple of years getting your MBA in the classroom? What was striking in terms of what you learned?
I think I learned just as much from the professors as I learned from the students inside the classroom. You learn how to listen, work in groups, and I look at the world with completely different eyes than what I did going into it.
And it's also a reevaluation of self and sort of what your purpose is in life or what you want it to be.
In the last couple of years, there's been this debate about business, and is business doing enough good?
We take jobs and what business can do for the economy for granted. There is something intrinsically good about creating something, yes, generating profits, but giving someone a job.
Interesting take, given the fact that the drumbeat about business is bad is pretty loud, isn't it? I mean, did you hear that drumbeat in class?
We were aware of the debate. We were challenged from day one to think about not only the business that we're doing in a micro sense, but to think about how it can impact, the global economy, and to think outside of ourselves, from our business to our community to our country.
So it sounds like, you all feel that the MBA was worth it.
Definitely.
Absolutely.
The investment definitely pays off. I think that longer term, this is like a catapult.
Congratulations to the class of 2013. Up next, a look at the news this upcoming week that will have an impact on the money. And then one NBA star hitting nothing but net when it comes to sneaker sales. Find out who's raking in the dough after the break. Back in a moment. For more on our show and our guests, check out the website, otm.cnbc.com. Now a look at the stories coming up in the week ahead that may move the markets and impact your money this week. On Monday, Americans will mark Memorial Day, honoring those who lost their lives while serving in our military. Starting Tuesday, 281 kids will compete in the 2013 Scripps National Spelling Bee. Also on Tuesday, the S&P Case-Shiller Index will report average home prices for the month of March. And on Thursday, we'll get the next estimate for the first quarter gross domestic product, which typically is a market mover. On Friday, personal income will be out for the month of April. Well, he brings the heat to every game, but four-time MVP LeBron James is on fire when it comes to sneaker sales. The basketball star's Nike shoe line banked $300 million in U.S. sales last year. It's a slam dunk for James as sales increased 50% from 2011. His shoes start at $180 a pair and go as high as $260. And yet, LeBron's stats are no match for retired NBA icon Michael Jordan. His sneaker brand hit $2 billion in sales for 2012. That'll do it for us for today. Thank you so much for joining me. My guest next week, mutual fund legend Jack Bogle of Vanguard. Each week, keep it right here where we are on the money. Have a great week, everybody. I'll see you again next weekend.